Hi everyone, this is Jitan here and welcome to another episode of Traders TV. Today I'm very excited because we're going to be talking about diversification, a commonly misunderstood tool and not commonly used by traders. However, you're going to see the power of diversification and what it can do for you. In the last episode we talked about how to profit from the volatility of Brexit. Today, we're going to talk about diversification and how you could be trading multiple markets like currencies, indices, and commodities to profit from such moves. So, let's get to it. So, diversification. What is it? How do we use it? And why is it important? Well, let's start with the what. Diversification is essentially building a portfolio with different assets or different markets or instruments that will on average provide higher returns than any individual investment by itself. For a trader, this basically means that we're trying to smooth out the risks in our portfolio by making sure the positive performances neutralize the negative performances. So instead of putting all our eggs in one basket, we're going to spread our eggs around, so just in case a couple of trades aren't working out, we've got some other trades that are potentially going to work in our favour, cover those losing trades and actually make a bit more of a return. We actually covered something similar like that in the last couple of videos when we talked about reward to risk, how we can actually lose on more trades than we win but still make a positive return because we'll be making more on each of our winning trades. Okay, so definitely have a look at that video if you have not seen that yet. So in terms of diversification, the key is really just to smooth out the risk in the portfolio, okay, by diversifying our trades, not putting all of our eggs in one basket, so the positive performances can neutralize the negative performances. So how, as a trader, do you diversify your own trading account? Because diversification is a very popular strategy among investors. So investors who are trading things like stocks and commodities and a whole basket of different asset classes, they will be looking to diversify a portion of their account equity, their portfolio, into different markets. So as a trader, how do we diversify our trading account? And our trading account is essentially our portfolio. Well, to do that, we look at trading multiple markets. Multiple markets help traders diversify their portfolio or their trading accounts. So again, how do we diversify the actual trading account from a trading perspective? Well, it comes down to the markets that you have available to you. Okay. Now, one of the key markets that I trade and many people trade and learn to trade is foreign exchange. So trading currencies like the euro, pound, Canadian, New Zealand dollar, US dollar, Japanese yen, Canadian dollar as well, and Swiss franc. So the key thing with currencies is that they're paired. Okay, so we're trading euro against the US dollar. Okay, so as the euro goes up, the US dollar will go down. Or we're trading pound against the Japanese yen. So we can diversify not only by trading different currencies and not putting all of our eggs in one basket and only trading the euro dollar, we can trade a basket of different instruments within that same market. Now that is a small kind of diversification because in any market, instruments can be quite correlated, okay? So we can go one step further and diversify our trading account by looking at stock market indices. Now, stock market indices are quite heavily quoted in the financial media. You may have heard about where the FTSE 100 is trading, or the S&P 500, or the Japanese Nikkei. Okay, these are stock market indexes. Now, with stock market indexes, they basically average out the biggest stocks listed on that stock exchange. So, for example, like the FTSE 100. It takes all the 100 top stocks listed on the London Stock Exchange by market capitalization and it puts it in an index, so we can see on a broad basis how the biggest 100 companies are performing in the UK. Same thing with the S&P 500. It takes the 500 largest stocks in America listed on the New York Stock Exchange and it puts them in one index so we can get a view on how these 500 stocks are trading overall. So it's a great tool to use on top of foreign exchange. And we'll come to the pros and cons with each of these markets in a moment. Another market that you have available to you as a trader to diversify your trading account is commodities. So things like gold, silver and oil. Those tend to be the most popular, but you can actually take it a step further and look at things like cocoa or sugar or cotton, coffee. So there's different types of commodities. Now, inherently, foreign exchange indices, commodities, there may be some similarities, but there's going to be very low correlations between what's happening in pound against the Japanese yen and the cocoa markets. And that's the key to diversification, is to trade on markets that aren't really correlated to each other. You don't want to trade a market where historically, as one market goes up, the other one goes down, because that means it's quite correlated. We actually want to have a market available to us where there's no correlation when we look back in history. So this is why the benefit of trading 3 different types of markets is very, very useful when you're trying to diversify your portfolio. Most traders just take it to one level and trade different markets or different instruments within the market they're trading. So they may say to me, oh well, I'm trading 30 different currency pairs, I'm trading all the euro crosses, euro Oz, euro CAD, euro Swiss, euro pound, but I'm also trading all the pound crosses, pound Oz, pound CAD, pound Swiss. Now some of those might be quite correlated because currencies are paired. The better way to do it, and the way to manage your account and be diversified from a professional standpoint, is to be able to leverage off your skill set as a trader and actually trade these multiple markets. And that's the beauty about trading, is the fact that you can leverage off your own skill set, because it's very similar, the skills needed to trade foreign exchange, to trade indices and commodities. Yes, you need to know a few different strategies because the markets do move a little bit differently, okay, which we'll come on to in a moment, but inherently you can leverage off your skill set. Okay, so those are the 3 most popular markets that we can use as traders to diversify our trading account: foreign exchange, indices and commodities. So let's have a look at some of these in a bit more detail. The foreign exchange market. Now the foreign exchange market does move quite aggressively. In fact, it's the world's biggest market. I mean, the average trading volume per day is about $7 trillion, and that's constantly growing. However, the trends don't last as long. You can get a very long trend if there is central bank intervention or there's been some kind of crisis or things like that, but generally the FX market or foreign exchange market is a bit more aggressive, so it tends to move around a lot more. Okay, now that's great because it provides us with much more liquidity. Because the foreign exchange market is so big, it's highly liquid, which means you can get in and out of trades very, very quickly. Okay, so it is great for short-term traders. However, with foreign exchange, it can be affected by economic news throughout the day. It's very sensitive to geopolitical events and economic news announcements. Again, that's great if you have the right strategy and right tools to use that to your advantage, because it can throw up a lot of different long-short opportunities. So long and short just basically means if you're going long, it means that you want to buy because you feel the market's going up, or your analysis suggests the market is going to go up. And if you're looking to go short, it means that you believe the market is going to go lower. So the foreign exchange market throws out a lot of different opportunities just because it does move that aggressively and it is very liquid. So this is ideal for active traders. Okay, those traders who like to be in the market, searching for opportunities on a daily basis. Okay, so that's foreign exchange. Indices. Now indices tend to trend for a very long time, much more longer than a foreign exchange currency pair will. So that's great for longer term positions, as it's not affected by daily news announcements, because the way the index market moves is very different to the way the foreign exchange market moves, and I'll come to show you that in a moment. So with the indices and stock market indexes, you may not get as many signals. So if you miss your entry, it means you're going to spend long times out of the market. But if you are able to time your trade and hold on to that trade, it means that your trade can then become very passive. So you don't need to do a lot, you don't need to be very active, you just need to be quite passive. So again, slightly different to foreign exchange, two very different markets there, but you can actually see if you diversify and use both markets, that's going to be great for your trading account. Because if you're not getting those short-term movements right off the foreign exchange market, then maybe you've got some of those longer-term trends happening in stock market indexes, which is helping to grow your account. So it's covering those shorter-term trades which you're getting wrong. On the flip side, if the stock market isn't throwing any opportunities because it's going sideways, or maybe it's moving down and you don't want to short it, or you've missed your entry and now you've got to spend a long time out of the market, then going to the foreign exchange market to capitalize on some of the movements there can be quite useful to diversify that trading account. Now, as a bonus, traders also are able to trade commodities, and this is a mixture of long-term trends and short-term trends, and it really is dependent on the individual instruments. Okay, the way the gold market moves is quite different to the way cotton moves. The way oil moves is quite different to the way cocoa moves. So sometimes in the commodity market, you find that the market can go very sideways for a long period of time, but then when it trends, it tends to trend quite aggressively. Okay, because these are raw materials. So if a big move is happening, a lot of institutions and commercial companies have to get involved in that market. So it's an interesting one as well, and can provide good opportunities, both short term and long term. Again, the difference between active and passive. So it's ideal for those looking for a blended approach within their trading account. So all three of these markets do move slightly different. The key thing with foreign exchange markets is the fact that currencies move based on central bank policy. Okay, and that's an important one to remember. Currencies move based on central bank policy. If central bank is increasing interest rates, or if the market believes a central bank is going to increase interest rates, then typically that currency will appreciate or outperform other currencies. If the market feels that a central bank is going to cut interest rates, then generally speaking, that means that currency will depreciate. Now, it's always important to remember that the markets move on expectation. Yeah, they move on anticipation of an event, of a fact. So that's how the currency market moves. And the people who are trading currencies are obviously quite different. Yeah, and they're more your commercial companies looking to transact and doing international transactions, and your shorter term traders and algorithmic traders looking to capitalize on smaller moves. Compare that to indices. Now, a stock market index is used by many fund managers because they run what we call passive portfolios. They're not always going to be in and out of trades. They're looking to take that one trade and hold on to it for maybe 6 months or even longer than that. So the type of trader or investor involved in the stock market index is slightly different, and that's why the market trends a little bit differently to foreign exchange. And with commodities, there's a big blend of institutional hedge fund managers, retail traders, and corporations, okay, because they're also looking to be active within the sugar market, within the cocoa market, because they need to lock in their price for the goods that they're creating. So within each of these three markets, you've got a different type of profile of people trading that market, which is why the market trends quite differently between all three of those. So that's great for us trying to diversify our trading account, because we want uncorrelated markets. So when something isn't performing as well, we're spreading our chances of a market performing well by being involved in other different markets. Okay, so foreign exchange, indices, and commodities, three best markets to diversify your trading account. So I'm just going to have a look at the Smart Charts platform so you can actually see these in real time and see the actual markets that are available to you to trade. And you can start to see a bit of the difference in the trends that I'm about to show you. So here we have a chart of the gold market, okay, and you can see the difference in the trends here. I mean, you can just see that on the left hand side we've got a beautiful trend, you know, going up from pretty much 2005 all the way to 2012, okay, pretty much undisturbed. However, you can start to see that recent times in over 2015, 2016, 2017, market has started to push a little bit sideways. So this is a good example of a commodity market where you can get a very strong trend, but there are also periods of time when the market may be pushing sideways. Now, if you weren't diversified and you only traded the gold market, then you would have done very well during that run up here, but then you may have been sitting out the market for quite some time trading through this. This is why diversification is quite important. Now, that's the gold market. In the left-hand side, you can see just a range of markets that are available. You can actually see that we have, at the top here, all the different types of indices. So we have the France 40, the German 30, two big European stock market indexes, the Australia ASX index as well, the Hong Kong Stock Exchange, Hong Kong 50, HK 50, the Nikkei 225 in Japan, we've got the NASDAQ, okay, the S&P 500, the US 30, all American stock market indices, we've got the UK 100 as well, Spanish 35, Stocks 50, so we've got a blend of European stock market indices, US stock market indices, and Asian stock market indices. And in itself, that is actually a good diversification process because you're then exposing yourself to things that are happening to America, things that are happening in Europe, and things that are happening in Asia. Sometimes it's not all correlated. Some economies might be performing better than other economies. So you may get quite good diversification within that individual market. Now, if you just have a look at the difference, you can see the gold market really, it's pretty much gone sideways for the best part of 2 years. If you compare that to something like the US 30, so this is a chart of the US 30, and this basically charts the 30 companies that are selected by the editors of the Wall Street Journal. Okay, so it includes the likes of Apple, General Electric. Okay, so big industrial companies, but also some technology companies, retail, consumer discretionary, and so on. You can see largely here since 2008, we've been going up in pretty much relatively straight line. Okay, had a bit of a dip there in 2014, and we've been pushing higher. Now you can see here that if you didn't capture some of these movements at the very beginning, then you may be spending a lot of time out of the market. Okay, because sometimes with the stock market, it just may not retrace far enough for you to get the best possible entry. This is why good diversification strategy is important. Just bear in mind this is a monthly chart we're looking at as well. So if you go down to the lower time frames, you then may be able to get into more opportunities. But you can see the trend here on US 30 is quite strong. Now if you look on the left hand side on this quote window, we can actually see we've got a whole basket of different currencies and different instruments. We've got all the Aussie crosses, Aussie CAD, Aussie Swiss, Aussie Yen, Aussie New Zealand, Aussie Dollar. And just as an example, we can see Aussie CAD. I mean, this here is just going sideways. Now the beauty about trading is the fact that we do also have strategies which we can profit from in a sideways moving market, which we can deploy on Aussie CAD. You can just see here, compared to the US 30, this is going sideways for the past few years, and the US 30 was pushing up quite nicely. So again, good diversification strategy. If you're just trading in Aussie CAD, then you're going to be very limited to the amount of opportunities you're going to get. Okay. So looking further down, we can see we've got all the Canadian crosses, we've got Coco there, we've got these Euro crosses, so Euro Aussie, Euro Canadian, Euro Yen, Euro Dollar, and all the pound crosses as well, we've got gold, New Zealand crosses, silver, coffee, US dollar crosses, sugar, oil. So a whole range of different markets there that we have different strategies that we trade on. Okay, and that's the whole thing about diversification. Yeah, if one market isn't moving like this, then at least we know there's a high chance that one of these other markets or some of these other markets will be trending. Okay, and then it comes down to what kind of trader you are and how you're going to be trading, what kind of markets you look for. But the most basic point of diversification is that the fact you're trying to smooth out your equity curve. So when one market isn't performing well for you, another market will be performing for you. That's diversification, ladies and gents.
Now, if that was a little bit advanced for you, fear not. I strongly recommend you visit the link below and attend one of our free Forex workshops where you can ask your questions to one of our live traders and actually understand the basics about what trading can do for you. So, I hope you enjoyed that video. In the next episode, we're actually going to be talking about trade management, which was suggested by one of our viewers. If you have any suggestions or questions, then feel free to leave a comment in the box below. In the meantime, I'll see you on the next video.